So Max and I got involved in Bitcoin in 2011, and that was the year of the first big bubble, which brought in all the speculators and changed the face of Bitcoin. But I think it's really important that we're here in Las Vegas because this is the West, and the nature of the West in America is still very similar to the original pioneers. All the gunslingers, the outlaws, the prostitutes, the missionaries, the freaks that came out here that were mad enough to cross the desert in wagons and, you know, basically fight the native people who lived there. And pre-2011, I kind of think of early Bitcoin as those pioneers. I mean, they were totally freaks, outlaws, pornographers, gamers, and the Cypherpunks were the very first. So I want to look at that nature of early Bitcoin and how it brought us to where we are. So the two guys at the end, Peter, Todd, and Adam Back, you guys were Cypherpunks, right? You were on the Cypherpunk mailing list. Tell us about, so this is pre-2008, October 31st, 2008. What was the role of the Cypherpunks? What were they trying to create with Bitcoin? Why did they create it? What were the conversations going on, Adam Back, in those Cypherpunk mailing lists?
Well, I mean, it's not clear that they created Bitcoin, but they certainly tried to create things like it, and that much we know. So like B-Money, BitGold, and halvings, reusable proof of work. So I think they were interested to have, people were interested in privacy technology, and things like Tor were operated by volunteers, and so they were interested to have, freedom of association, freedom of speech, and also it's like transactional privacy, so that you could buy things online, for example. And so there was a lot of interest to solve the final thing. There were ways to communicate privately, to discuss things, to publish things anonymously, some censor-resistant publishing, but no way to transact privately. And so they're interested to solve that problem. Now, apparently there were people interested in two aspects of this. So I was talking with Nick Szabo recently, who said that he was actually significantly interested in monetary reform, so the kind of gold aspect. And other people were interested in uncensorable money, bearer money, things like that. So now in Bitcoin, those come together and you get both. But there was certainly a prospect that a system could have been built that had only one of those properties, that had only privacy, but was, let's say, backed by dollars or something like that.
Well, and also, I mean, you do have the potential of having payment systems that are based on money that inflates. I mean, my early ideas for Bitcoin back when I was like 16, amongst many things that they were broken, one of the things that was broken is I couldn't figure out how to get inflation under control. And the reason why is, of course, my idea about how to make Bitcoin was dead wrong. But at least at an economical level, you could imagine a payment system where your money is going to inflate away to nothing, yet it's still useful for transacting from one person to another. And I was interested in censorship-resistant money because, I mean, that's an important requirement for politics. Even if you want to have a protest, someone needs to pay the bills to go and buy the sticks for the signs to attach to.
So, I mean, I think where Hashcash as a proof of work came into this money story is people had seen DigiCash, which had extremely strong privacy and crypto fungibility, but was centralized, so they'd seen it fail and a double spend database disappear. And so they wanted a way, and it, to operate it needed a partnership with a bank, and that was hard to achieve. So people saw Hashcash as digital gold. As Peter said, there were technical challenges about how to control inflation, but nevertheless, I think the thing that most attracted people to using it was that it was permissionless, and you could create coins just by mining them. So people saw the opportunity to mine the coins into existence. So just in
and these older ones that are infusing us with these cypherpunk ethos values. I think, Peter, didn't you even have an email to Dr. Back, like clear back then?
Yeah, so I wasn't actually on the cryptography mailing list. I was on something called the Blue Sky mailing list. And that's where I first talked to Adam Back and also Hal Finney of our very early efforts to basically try to go and invent Bitcoin, which were all total failures.
You wrote to Hal Finney in 2001. You were
Yeah, I was 16.
Yeah, so I think it's important to understand, like, this has been in the works for decades. And
Yes, I think that's important that it's
yeah.
like it didn't erupt suddenly from one guy. It was, or one group of people. It was decades in the making.
Yeah, and Peter and I, we were having dinner with Nick Szabo, and Peter was actually arguing a little bit with him, and Nick's argument back was that this is an iterative process. This is an iterative market process of creating the new money and creating new goods that have these monetary properties. And, you know, it's only to be expected that we're going to continue to have this type of iteration that takes place.
And just like the West, Vegas, all these places still have that original sort of ethos of being like, you know, fuck the government, you know, standing up to the government. I think with Bitcoin, you still have that, no matter what, you still have that cypherpunk notion behind it. Max, you were, you created the Hollywood Stock Exchange back in the mid-90s, and you had that issue that Peter was just talking about in terms of the double spend and inflation and how to create a currency. You created a digital currency that actually had an exchange value.
Yeah, the Hollywood Stock Exchange. I came out of Wall Street in the 80s, and it was a very fertile time for innovation and creativity, and Mike Milken had his heyday, and I was a young stockbroker at that time. And so I grew up to learn this idea that markets and finance are completely plastic, and you just make them however you want, and there's no sacred definition of money. It's whatever gets sold, that's what money is. And during the 90s, I was in Los Angeles. I was very impressed with the SETI project, the Search for Extraterrestrial Intelligence, which is this massive parallel computing project to hunt for radio waves in outer space. And that set me up for Bitcoin in a lot of ways, because it was everything that I was thinking about digital money, and then a massively parallel computing project that would tap into a global expression of what money is. And this seemed like kryptonite to me, to all the bad guys. And when you work on Wall Street, it's like you work in a meat processing plant and you become a vegetarian. Working on Wall Street, you see how much criminality goes on there every single day. It's completely accepted. And fraud is the business model. And so when Bitcoin came around, I was like, this is going to be kryptonite, because there's no way that these guys are going to be able to control this. And so now here we are in 2020, and these guys are getting closer with regulations. One quick side story. With the Hollywood Stock Exchange, people ask me, how come I can't trade box office futures? Right? Because Chris Dodd of the Dodd-Frank bill, when Cantor Fitzgerald bought the Hollywood Stock Exchange, at the very last minute, they passed a law called the Dodd-Frank bill, and box office futures contracts are outlawed in America. So Cantor Fitzgerald took a massive hit on that acquisition, and I tried to convince them not to go ahead with their plans, but they did it anyway. And so that's a good lesson, I think, is that especially now when encryption's being attacked and regulated and forced to be disclosed on devices and things like that. So the regulatory battles for this industry, the big ones, are still ahead of us, I believe.
So, you know, in terms of that ethos of Bitcoin and the cypherpunk ideology is, you know, cryptography used to be considered munitions. So it was an actual U.S. security and national security issue. And here we have Bitcoin. It has become sort of a munition against the banks and against this financial surveillance. But at that time, so after January 10th, 2009, when Hal Finney tweeted running Bitcoin, after that time, how important is it that the only people who joined in on this thing with him were the gamers, were the outlaws, were the pornographers, were the freaks? Like, if it had been like KPMG and Fidelity Bank saying, okay, let's get in this together, would it have changed the nature of Bitcoin, do you think?
Probably. I mean, I think there's a history. So Tim May, who was one of the Cypherpunks list co-founders and was one of the first people to write about related ideas, he made the point that most innovation comes from the sidelines. So, you know, if you want to change things, just do it. I mean, just build something. If people want to use it, they opt to use it, and it changes people's expectations about what they should be able to use. So, Skype is another example, right? So, Skype got into the telecom industry. If they'd got, and telecom sector is regulated, so if they'd gone to the regulator and said, we want to build a voice over IP video system with free international calling, they would have said, no, you can't do it. All the groups would have stopped them. So instead, they just did it. And the regulators were too slow, it got too widely used, and they couldn't stop it. So I think Bitcoin, is something in that area where people just did it. Initially it had no value, no stock, no exchange price. The 10,000 Bitcoin pizza experiment. So people were just playing with it. I mean, it was a kind of hobbyist thing. I think the fact that you could mine it helped add value. There's a psychological phenomena where if something's difficult to do, people ascribe more value to it. It's kind of a fallacy, really. It's kind of labor theory of value, but it's some people have that intuition. So I think the fact that the mining was difficult, fiddly, and people would exchange tips on how to configure graphics cards to do things, made them feel it was valuable, and that maybe had a part to play in bootstrapping a value, because it had to bootstrap somewhere. So I think it's all about permissionless innovation, and then there's a history of sort of open source community technology being found to be agile and good, and later being adopted for more enterprise uses.
I'd make the point. I think the kind of list of people who kind of say got into Bitcoin, I think that's actually, much too restrictive. I mean, I know financial people who saw Bitcoin and immediately realized, oh yeah, that's a good idea, I'll go buy some. And I mean, my dad's a standard, Keynesian economist. I mean, used to go do consulting for pension plans. And when I first described what Bitcoin was to him, his reaction was, well, of course that's valuable. It was just completely obvious to him. Like, you have a limited thing, you send over the internet. That's useful. I don't actually think like this is that radical of an idea. I think what's more radical is being able to actually do it and pull it off. But, if you do it in a slightly different way, I mean, I think you'd still get a similar kind of outcome.
But at that time, they show the velocity of Bitcoin from 2009 through present in terms of how often they move. And it does look like a lot of those early Bitcoin are lost forever, or they lost their coin. So that took a while to overcome, I feel like. In 2009, 10, and 11, I mean, these things like Bitcoinica would pop up, and somebody would run off with 53,000 coins, and it just felt like a kind of a game that it wasn't real, and that maybe it would never have value. It was just a game.
But the notion that something is a game and it's not real yet doesn't change who might be interested in playing with it. Yeah. Someone like my dad, if they actually knew some technology, and well, frankly he doesn't, but if he had the technical wherewithal to actually go do something, I mean, he's the type of person who would. I just don't. I'm just so reluctant to go and say that finance people wouldn't have been interested in this early, because I think it's not necessarily as radical as it sounds, and I think once you understand what it does, it seems kind of obvious. I mean, kind of in the way that, I wouldn't really call gold radical. I think I'd call gold radical in terms of the political parts of it, but in terms of the mechanics of, well, is there this valuable thing and could it be valuable? That's...
Well, of course, Max, you were a banker. So how did you, when you first started talking about Bitcoin in early 2011, like, how did you see the value proposition in it?
It was analog to gold, right? So, I mean, that's the thing about, I understand Peter's point that, okay, somebody who's reasonably involved in finance would get it, but I don't understand why people who are into gold don't get it. I don't understand that. I never did. We came into it on our programming side when gold peaked in 2011, and we transitioned to doing heavy Bitcoin coverage because gold was no longer a hot topic to talk about because it entered into a very long bear market. So this gave us a programming supplement, if you will. The more we talked about it, the more access we had to more key people who would contact us and say, hey, I'm a programmer, I'm a developer, I'm doing this, I'm doing that. So then we just kept putting them on the show, And so on a programming side, it was great. But how do I talk about it to people who are newbies or whatever? You know, I would just, as far as, I just found this wall of resistance. I think there's people who either want to be free and there's people who want to be slaves. That's it.
In up until 2011, when we started covering it, we were covering the financial crash. So I mean that was relevant to Chancellor on brink of second bailout for banks, because we were covering the UK and the collapse of the banks there. And when we had a lot of gold bugs, we were talking about gold a lot as at that time the only solution to this financial system. And on the first episode that we ever did on Bitcoin, a lot of gold bugs were in there, and they say, "What's this Bitcoin? More like a shit coin." That phrase was used back in 2011 about Bitcoin. It was actually their anger that made me even more curious about why are they so afraid of this? Like, this seems weird. I know you had, you were a gold holder and a big gold investor, but you saw very early, like you moved your gold over to Bitcoin at a very opportune time. I don't think I was clever enough to do that at that point, but how did you, what made you do that? How did you see that?
Yeah, so I'd actually become an investor in gold money. That Max and I were both involved with gold money before Bitcoin even existed. And so I was an investor there in, I think, 2005, 2006 timeframe. And then I started a blog, Run to Gold, and I'd had breakfast with Dr. Edwin Vieira, and he gave a talk at the GATA conference, and someone asked, like, well, why do we do this? It seems so bleak. We don't have any chance to get out from this gold price suppression scheme and the monetary repression and everything. This was 2008, middle of 2008. And Dr. Vieira said, well, I don't want to live in 1956 Czechoslovakia with a boot on my neck. So that's why I got more active blogging about gold and the monetary role that it plays in protecting human rights and civil liberties. Stands as a protector against despotic inroads on the part of governments, as Mises says. And so then when I came across Bitcoin, it was very natural to merge, at least for me as a digital native, growing up with LimeWire and Kazaa and all BitTorrent and eGold and the digital games, and transferring value over communication channels and dealing with chargebacks and trying to get paid for your thing in the game, right? So for me, immediately, I was able to see the implications of the software code and what it's going to do. And so, that's why I kind of picked it up. And actually on this stage, in Nick Szabo's first public appearance, I asked him the question, what niches should we go after? And he was like, we have to go find particular niches to sell Bitcoin to. And that's exactly what I'd done. I went to the libertarians. They are just crazy, and I want them to have a lot of money on the other side of the wealth transfer. And then also the gold bugs, because they should have understood gold, the role of gold, and therefore the role of Bitcoin as digital gold. Well, Lou Rockwell, I've got the emails. He's not interested in Bitcoin at all, and along with Tom Woods and a bunch of these other libertarians. Surprising. You get to hold your own keys to your money. It's scary technical stuff. And then the gold bugs are just complete troglodytes. James Turk, it takes forever to finally get them to launch. I mean, I bring Bitcoin to the Gold Money Board of Directors at a quarter. Like, they could have been the exchange. Physical gold, physical Bitcoin, and USD, like no Mt. Gox. They totally missed that multi-billion-dollar opportunity because James Turk is, wants to be important as a thought leader. They eventually launched Natajia, which flops on its face like 5 years too late. And, as shareholders in Gold Money, we're not too happy about that. But it just shows that, it's not easy to get this. It's so multidisciplinary in so many different areas that are all at work. And
well, we made a 10-part series called To the Moon, and we asked dozens of people, including yourself, what is Bitcoin? And it's remarkable how right everybody was, but completely different answers. So it is a lot of things. And part of this whole, that first price run up, I guess it's the title of the show, the 2011 pop. You know, so when we had covered it, it was like somebody in the comments, I looked back at it recently, said, you know, when they were talking about this being a shit coin, is like somebody scammed $50 million out of these people. Think about it, 21 million coins times $2.25 or something. Then it went up to 7 or 14 and then crashed, and then went back up to 30 and then crashed. And you see all these comments, people talking about, fucking Keiser, you made me lose my life savings. I put 10,000 bucks in and it's all gone now. And but what is the role of, well, I know you have something to say, but also Max, because you've developed a market making technology. What is the role of all those losers and speculators? People act like it's a bad thing that there are speculators in these markets.
Yeah, so first network effect is speculation, you know, these 7 network effects. And the speculation network effect is so strong in human psychology. San Francisco had 800 people when gold was discovered. That city is built because of speculation, and it still operates that way, the center of technology speculation, right? And so just people wanting to chase the rabbit, like they'll chase it up, they'll chase it down, like they want to chase the rabbit all over the place. So, you know, that speculation network effect is so strong. The Dogecoin hasn't even had any updates for 5 years, and it has a $263 million market cap. It was launched as a joke, you know, and it's still like alive because of the speculation network effect. And, you know, it's in those early days, it was so hard to buy Bitcoin. I mean, web of trust, sending cash in the mail, hoping you're going to get your Bitcoins. And you had to have so much conviction to actually buy it. You know, think about it, to actually buy it. And then when it's running up and down, everybody thinks that, like, hodling is easy. Like, it's not easy, you know. It runs from $2, 25 cents to 32 bucks and crashes to 2. Like, you know, people get shaken out on that. And, you know, when you have this large hodler base and it's an illiquid asset and hard to trade it and hard to buy it and sell it, like, what is the price of it really worth? You know, it's hard to determine that. And Adam and I, we have a friend that the guy actually emailed Satoshi before Bitcoin even got launched out. So he's got a coin or two, right? And he was selling some of them, and I had introduced him to another friend of mine in Southern California, and we're at the pizza shop negotiating the deal, and the spot price is like $5 for Bitcoin, and he wants $5.25 because it's a large block of the coins. And my friend doesn't have the conviction, and so he passes on the deal. And that 25-cent difference in spot was about $50,000 on the deal because it was 200,000 Bitcoin in one large block. It would be like $2 billion today. And I mean, I'm like, you know, I don't have any money at the time to buy like that because I'd already bought my Bitcoins earlier, right? So, I mean, when you get conviction on something, you just have to buy it. And price discovery is difficult and everything. Like, it's, I mean, it's just hard, you know. And then you got to hodl those things, right?
So Max, your role as a market-making technology guy, and you know this also lends to Mt. Gox and all the things that went wrong there in terms of price discovery, and the role of speculators in setting this.
Well, a lot of people say, where does the money come from? And it comes from losers.
That's true.
That's where money comes from. You know, without losers, there would be no cash. And you need capital for capitalism. So God bless the losers. Did I mention Peter Schiff? No. Well, here's the classic case: a gold bug who is attached to their dogma, who was gifted Bitcoin and then lost the password, lost the keys. They lost them within 20 minutes. So that's somebody, you know, that is expendable going forward. We don't need that in the DNA pool, do we? We can survive better as a species if that was weeded out, in my view. But if the question is market making, what about market making? You have the price discovery. That was always a mystery on a lot of these exchanges like Mt. Gox and others, because market making is not easy to accomplish, actually. So to create a price discovery that is reflective of a market, you know, in the New York Stock Exchange, it's done through a specialist system, and the specialist maintains an inventory, and they're allowed to front-run orders. They're allowed to buy or sell ahead of customers to maintain their liquidity. I remember Alan Greenspan, when he was asked this, he said, you know, these specialists on the New York Stock Exchange are engaged in insider trading. He said that technically is true, and it's technically, they're very restricted, and it's technically illegal, but sometimes in capitalism you need a little wiggle room. So Jamie Dimon heard that, and he said, you know what, I can build a bank based on that. Yeah, it's a wiggle room bank. Every single thing we do is wiggle room. We don't actually offer an honest service. But that wiggle room became the moral hazard of the next 30 years of finance. Everything is now moral hazard because everything gets bailed out. This is why Bitcoin is growing in strength. But anyway, on the market making question. So you have, with Mt. Gox, it was clear even from the Hollywood Stock Exchange that this thing was going to blow up because you could look at the order books to some degree and get a feel for it, and you could figure out that they were front running massively in a way that was going to not end well. And so that was why we told people on the show to stay away from Mt. Gox. We warned people and said, get your keys off Mt. Gox. It looks like it's going to blow. Sure enough, it did.
Peter, it looks like you wanted to jump in there.
Well, so a point I'd kind of make is, you know, it's interesting you keep on talking about like the gold bugs versus the Bitcoin people. And, you know, something I think I've kind of noticed is how being a gold bug is actually a really pessimistic outlook. And, you know, whereas Keynesian, like, all right, it's going to keep growing up by, you know, 8% every year. That's a really optimistic outlook. It's a really nice feeling. Think, you know, I can just go and rely on my compound interest to go retire. It's just going to keep going up, keep going up. We'll figure out some way to, you know, keep investing and so on, keep pumping money into all this. And it's interesting seeing how you talk about these gold bugs, like I think there's this very pessimistic thing, whereas Bitcoiners are sort of this weird in between, especially in the early days, where there was so much potential. And then I think the psychology of people getting into that is actually quite different from the psychology of the gold bugs, whereas the rationale is kind of the same.
Yeah, it was, yeah, the gold bugs, like, by the way, we went to many conferences with gold bugs, and they were all in suits and looking very nice and sharp, and then Max Ash and Lambos.
Yeah, I mean, part of the market process, well, one is if you calculate correctly economically, you have profits. If you are incorrect, you have losses. That's Mises. So Peter Schiff, like, he's racking up a lot of goose eggs. But I put out a poll on Twitter, gosh, like a month ago or whatever, and I asked, like, what are the most important classes in the ecosystem? The buyers of last resort, the hodlers of last resort, the sellers, or the miners, right? And I found it very interesting that over 60% of the responses said the hodlers of last resort. But Dr. Back made a reply on there, and someone else made one with the same sentiment, that it takes a lot of conviction to hold the falling knife, but it takes more conviction to buy the falling knife. And so the hodlers, you know, help provide that price floor, but the buyers of last resort are the ones who will buy when no one else will. You know, and then they'll catch that falling knife and they start the recovery up. And, you know, and there were times when, you know, $100 of cash in an envelope was the entire buy-side volume in Bitcoin globally. You know, so it's, you know, who actually has real conviction in the asset. And it's going to be the hodlers who will hold it to zero to become worthless, and it's going to be the buyers of last resort who kickstart the recovery. And there is a difference between the two, and the difference is that the buyer of last resort has to have financial resources to step in to do the buying, right? Like the hodler can hold that thing to zero, but he can't get the price to go up because he has no resources to reallocate to buy to move that price. So you have to, you know, they're comrade in arms, but really it's the buyers of last resort that are the most important when you're looking at price discovery on an asset.
Keep in mind, a hodler of last resort can just be someone who time locks their coins. You know, you can be in that position involuntarily. Whereas if you're going to buy, Well, if you're involuntarily buying, something really wrong has happened. Maybe it's called taxation.
Yeah, I mean, I think the buyers are. I mean, I think people can get stuck sitting on the fence, so they're indecisive. I saw it during the period where there were forks on the market and futures on the forks, and so people who were indecisive and didn't really have an opinion, felt underinformed, or were just scared, would do nothing. And if you do nothing, that's like the holder, and you don't actually move the price. I mean, okay, you reduce the supply on the markets, you haven't panic sold, but it's the people who, took significant financial risks to buy the fork futures, to sell, to short it, basically, who profited. And, I think that market signal was actually instrumental in forming opinion around it, right? Because the fork couldn't seem to hold 10%, and, effectively that fork is now in the low fives or something. So it seems like, the people who are activists, there's this theory about the intolerant minority. So the activist investors are the people who kind of lead the market sentiment and turn things around. So yeah, I think people have all these philosophical claims, but unless you've skin in the game and vote, you're actually sitting on the fence.
Well, yeah, to follow up on that, too, so you mentioned the hard forks there. So you have 2 hard forks that I'm aware of that are without a lot of buying support at the moment, but the principals are big bag holders, right? And so they are resorting to getting some kind of attention their way by parading around in public as absurd freaks, right? I mean, Craig is trying to gain attention as a deranged freak to get someone to buy this piece of shit before it goes to zero.
Well, and another part is just the flawed economic thinking that they have. And what I mean by that is you've got 8.3 million B caches that have moved since the fork, which means you have 9 million that haven't moved. And these people got them passively, and they might not necessarily have conviction and want them. And so
or those are all the people who lost their private keys.
Yeah, I doubt it, because some of those over 10 million Bitcoins have moved since that fork. So there are at least 2 million B caches that the Bitcoins have moved, but the B caches haven't, right? And it's like whack-a-mole. If someone sticks up a bid, you're going to whack them on the head with all that extra B cache supply. And so, we've seen a lot of different innovations, like Stellar's a good example, where they did an airdrop where you had to affirmatively claim. And so that way they avoid having this large overhang of supply that can get dropped on your head if you're trying to be in the intolerant minority going against the consensus.
When was the first, well, first of all, let me ask you, is it halving or halvening? I know this is the big controversy today in these. I say halvening.
It's whatever you want it to be. It's a free market.
Okay.
I like halvening because it's a unique Bitcoin word. And
Yeah.
Bitcoiners like memes and unique words.
Plus, if you say halving, it sounds like having, like I'm having this. Anyway, when was the first halvening? And that impact back in those early days of Bitcoin, but how do you think what sort of impact do you think it's going to have on Bitcoin in terms of the supply to buy?
Well, I mean, there's some debate around the stock to flow discussion, right? The reduction in new supply that comes after the halving, if the buying demand is constant, then you would expect the price to increase around that. So that seems straightforward enough. Now it does also trigger some kind of economic cycle for miners. If the price doesn't move across the halving, the less efficient miners will leave the market because they will be below break even. So I mean, historically, there were conspiracy theories or concerns about death spirals, but they didn't remotely happen in practice. There are too many people with different economic factors. People on power sharing schemes, people with new equipment that's more efficient, people who will keep running equipment and then maybe default on a power bill later, or mine for a bit, hoping things to see how it goes, see what happens afterwards if they've got a cash reserves to do that. So in practice, it hasn't really proven to be a problem. And I think it's generally positive. It's something for people to talk about, sets an economic pulse. Now, clearly, it could have been a smooth function, but it wasn't. And now that we have it, it's don't think people are going to want to change it.
Yeah, I think like if we look at what the Federal Reserve, really the only control they have is over the throttle, how much gas goes into the engine. They don't really have much control over what happens after gas gets in the engine. And ways to never pay more for an acquisition than you have to. And what are we acquiring from the miners? We're acquiring security, right? But how much security do we want? Now, some people might make an argument, well, as much as we can get. Well, that's like, how much are you willing to pay for peace? Well, as much as it costs. That is irresponsible spending. You need to acquire peace for the lowest cost that you can. And so likewise, if we can acquire security for the lowest cost possible, that means a higher stock-to-flow ratio, then that means that capital moves in for that monetary premium because they're paying less to store their value there. And that, and as Bitcoin continues marching that stock-to-flow up, it increases the barriers to entry against any other good that tries to come in, because with a pure proof of work model, and you have to have that pure proof of work because you got to give the electricity company dollars, right? So it's all about like what is your daily emission in USD, and that's a great way to measure how secure your network is. Bitcoin's $19 million a day. Monero's like $100,000 a day. Like they're not even comparable. It's like T-ball and the the Major League Baseball. So, but if we can reduce the amount that we're paying for that security, but still maintain an adequate degree of security, it's all the better for the hodlers, because then that means that any additional dollar that comes in or any additional capital that comes in further increases the total value of all the stock. And so, and Adam might understand this better, but as I understand it, miners can create, under the protocol rules, they can create at most, the 12.5, but we could do a user-activated soft fork where they only can create 3. So we could actually harden the money even faster, which would reduce the expense or the cost that hodlers incur by storing it. And so, that would be awfully contentious, perhaps.
I would think so, yeah.
But Ethereum's done it, if I remember correctly.
What's that?
Ethereum's done that, if I remember correctly.
Begun hardening their money supply.
I may be misremembering this, but I'm sure I have heard an example where at least one coin's gone and changed the way that emission schedule worked after the fact. And come to think, I think Monero actually did this really, really early on too.
Mm-hmm. And so, we have to look at all of these factors, because, like, why do people hire Bitcoin? Well, are we hiring it to store value? Well, if we're doing that, we want to have the lowest expenses possible for the people who are hiring it.
Although I'd point out, like, this as an engineering problem, you get a really fundamental issue that in a decentralized system, there's no easy ways to apply the levers to this. And even if Bitcoin was a centralized system, we have a very hard time figuring out how expensive, how much money should we go spend on peace, per se. Like, it's a very, very tough decision to make. Whereas I'd say the sane way to look at it is say, all right, what's some number that's sufficiently high it might work, or at least probably would work, and sufficiently low that we don't have to care that much. Because after all, there's no reason if the inflation rate is, say, 0.1% to make it 0. If you can't take a 0.1% haircut to preserve the value of your thing, what are you doing with your life? So like we certainly should go pay something. And if I could go time travel and be Satoshi, or at least I should say redo what I did, I would definitely have a permanent low inflation rate at the end. I just think it's a safe, easy system. But then again, I go look at the halving and think, this just seems really risky. The death spiral certainly can happen in theory, and I don't like things that can happen in theory. I'd much rather say, all right, this definitely can't happen, and we don't have to rely on 3 other things going our way.
So, I think there were a lot of misunderstanding about the degree of control miners had in the ecosystem before the forks, because it seemed like the people that were proposing these forks wanted to pivot Bitcoin to from a digital gold into more a retail, lower security model. And, you know, at the margins, you could have a reasonable trade-off discussion, but at the extreme end of things, I think that makes no sense at all. You know, the result of the forks showed that miners actually have no control at all because, you know, as Trace was saying just a minute ago, they are forced to pay electricity bills. So, you know, if somebody is a gold miner and they're digging up gold and then they find a big stash of copper and they go, oh, well, we'll mine that instead and sell that as, you know, it has a cost to extraction, therefore it has a value. You know, labor theory of value fallacy. So, you know, basically, I think people misunderstood miners' philosophical support from the practical support. If you try mining and you can see that, you know, by the end of the week you're going to be bankrupt, you're going to stop doing that fast, right? So effectively what people found is that by running your own full node, you're pretty much immune to the opinions of third parties. And it's certainly good that we've seen a lot more adoption of full nodes, a lot more power users running full nodes since then, because it largely makes you immune to their opinions. I mean, they can, you know, slow down transactions or create a few problems in the short term, but ultimately they can't change the definition.
So protocols like Lightning and to an even bigger degree Liquid have this really curious property where they further take away control by miners and that getting transactions mined quickly doesn't matter that much. You know, Lightning, of course, does have this issue where if miners censor for long periods of time, you can get ripped off. And then Liquid, it's like, well, screw you. We have this other security model where as long as that goes and works for our purpose, blocks could sit there not getting mined for months and Liquid would still function.
Yeah, and a good example of that would be, you know, if Bitcoin is $19 million a day of USD and emission rate, and Monero is $100,000, then you can actually get a relative number of days that you would need to get cumulative difficulty on top of your Monero UTXOs to be equivalent to one Bitcoin confirmation. You know, so and if you're a long-term hodler, you know, you just want to keep piling up as much of that cumulative difficulty on top of your UTXOs, and okay, I'm just, you know, going to wait for 5,000 confirmations. You don't need to wait for 6.
And don't forget, miners who want to attack the protocol always have this existential threat where what Bitcoin is can go change. You know, if push comes to shove and they try to destroy the whole thing, we'll probably go and appoint, you know, 10 people in charge and have them sign blocks. And as bad as that sounds like an outcome, that actually is protective because it says don't even try.
Yeah, I mean, I think people sometimes get overly hung up about how the current system works and the current game theory, but ultimately people need and want money to work. So if one part of the ecosystem tried to degrade the system, it's anti-fragile. You know, people would find other ways of making it work. And there are certainly many other forms of money that are far less secure than Bitcoin. So I think Bitcoin could, you know, react and persevere and transact in some, you know, what people would look at today. If they look at the current protocol and they say, well, if that happened, it'd be disruptive. No, it won't. You know, people will change it and fix it and work around it until the miners, let's say, give up, or the attacker gives up because they have no effect. So you only have to, like, deter them long enough for them to give up.
So in the last moments here, we have to wrap up, but let's bring it back to the pioneers of Bitcoin. You know, when we settled the West and you're talking about security, of course you had the gunslingers and you hired posses and you, if somebody stole your stuff, there was no government to protect you. You had to pay somebody to go find the guy, track the guy down and take your stuff back. In terms of the equivalent in this space, these pioneers that are on their own, first of all, how do you feel about these the new wave of people who've come in after 2011 demanding regulation and ETFs and all sorts of things like that? And does it, you know, does the toxic crypto Twitter, I'm not talking about you, Giacomo, does that aid the anti-fragility of it? Does it, you know, does it maintain the value proposition essentially of an independent sovereign currency like Bitcoin?
I mean, I think, you know, there's this concept of a perpetual September, which comes from early internet, where new users would arise when they started university or college and first had access to the internet. And because it was growing, the internet was growing so fast, there were always vastly more new users than existing users. So, you know, they take a while to adapt and learn. So I think it's just part of the educational process. And in Bitcoin and cryptocurrency, there's another factor, which is people talking their book, right? So a lot of the, oh, it's positive, we're talking about another coin, is competing with Bitcoin, but, so they're selling something. And so you have to look at what they're saying through the lens of, actually they're talking their book, and Bitcoin people are just trying to set the record straight and point out fallacies that are going around.
Well, when all the settlers came out here, there were a lot of people selling fool's gold to them, to these people hoping to strike it rich.
Yeah, I think Professor Christensen, who recently passed away, the Harvard marketing professor that wrote The Innovator's Dilemma, he hits on this issue, right? Like, we have evolutionary innovation, Schnorr signatures, Taproot, things like that. But disruptive innovation, is there a potential for disruptive innovation against Bitcoin? And if we are dogmatic and close our minds to potential disruptive innovation, then we open ourselves up to being disrupted. When really, if there is potential disruptive innovation possible, we should be the disruptor. Instead of just one head on the dragon, you have two heads on the dragon, or however many heads on the dragon that the potential disruptive innovation enables. So that's something to keep in mind, because everybody's always going, like, it's number one on CoinMarketCap. Everybody wants that position, and we've seen a lot of attempts at it. Bitcoin Cash and Bitcoin Gold and Stellar and Ripple. I mean, it's crazy that Ripple sits up there with a $15 billion market cap.
But does the existence of all these shitcoins, does it just make Bitcoin more anti-fragile? It just proves it over and over that this is the only.
Yeah. I mean, every day Bitcoin has to prove itself. And so it has to keep itself defended against potential disruptive innovation. Kodak, they totally could have owned the digital camera market. They totally could have owned it, but they passed. They passed on the digital camera market, and they're bankrupt. And using the Dogecoin example, I mean, it's incredibly difficult to kill any of these protocols. But that doesn't mean that there couldn't be potential disruptive innovation. And actually, because money is this iterative process that Nick Szabo talked about at dinner with Peter and I, we're only to expect that there is going to be additional insights and understandings and applications that could potentially become very disruptive.
I think you're much better off, though, looking at that not from the perspective of a Bitcoin owner, but from the perspective of a cryptocurrency owner. Because the problem with disruptive innovation is it's very easy to go cloak attacks on a system like Bitcoin as disruptive innovation. You disrupt the system by innovating, something that doesn't actually work, doesn't actually innovate. And it's much safer, actually, if you're a cryptocurrency holder, to say, well, why don't we go and have Bitcoin do what it does well and do incremental progress, and then allow other currencies to do disruptive innovation. And if it actually works, well, great. Well, I'll just go switch my money from Bitcoin to, Ethereum or whatever the heck it is that actually works. I mean, maybe it'll be disruptive innovation that isn't money. But that's a better system than saying, well, yeah, just because Ethereum might have some good ideas, let's go take all their potential experiments and then try it on Bitcoin.
So I think the other thing is, there are a lot of coins, and the primary thing that ICOs and pre-mined coins have fueled is actually creative marketing and overselling of defective features. So if you look at the efficiency of use of capital between startups that are just building protocols on Bitcoin versus the money that went into ICOs, I promise you it's in the order of 100 to 1 improved capital efficiency in the Bitcoin space versus basically squandered wealth, lost societal progress effectively. But markets become rational over time, and so I think there are pockets of innovation in maybe in the privacy coin space and in academia outside of cryptocurrency itself, just general cryptographic protocol progress. So I think the other point is that most of the innovation is actually coming from the Bitcoin sector actually in practice, and the other factor is that if some innovation does arise that's useful enough, Bitcoin can always adopt it. And ultimately, Bitcoin can largely adopt anything because even if it's very alien technology that's hard to integrate, you just start a Bitcoin 2.0 and you import the UTXO set and you resume. So the network effect is preserved. So you can in principle adopt almost any conceivable technology. So I think the only thing you wouldn't want to adopt or you couldn't adopt is drastically changing the ownership ratio or something, resetting the UTXO, which is crazy. You wouldn't want to lose the network effect.
And final word, Max, then we have to end.
You don't change Bitcoin. Bitcoin changes you.